Welcome back to the HMO Property Show. I'm your host, Neil Gibb, and this week we have the UGG Boot Investor. Oh,
Hello, everybody.
I was going to say your name there.
That's all right.
Welcome to the podcast, Mr. UGG Boot Investor.
Thanks, Neil. Really appreciate it.
Now, myself, and this is pretty tricky without saying your name, but we've been friends, and he's also a client of HmoPropertyco for, I would say, 2 years now.
Yeah, going on.
Yep. A few HMOs under your belt. Things are going good.
Definitely. It's a very strong strategy, and because it's a strong strategy, and because not a lot of people are doing it, it's really a good time to be jumping in to try and capitalize on this niche market opportunity.
Yeah. So for the listeners, who is the UGG Boot Investor?
Oh, I don't know. How would you define myself? I guess I'm just like everybody else. I work a 9-to-5 job. I have moved different industries over time. I've managed to build up a fairly sizable investment portfolio by a fairly young age, around the age of like 32, 33 now. And that's given me a lot of freedom. And my life objectives have shifted from really all about me to all about how I can help other people as best as I possibly can. And so that led me on a journey to create the persona of the UGG Boot Investor, which is effectively a YouTube channel to document the way in which I think about investing in personal finance, such that really it's about making an impact on other people's lives. I'm hoping to leave a legacy for my children and my wife if there was something to ever go wrong with me. Touch wood that it doesn't. But leave that kind of mindset and the way in which you think about and solve problems in this financial and investing space, so that you can get ahead reasonably safe without taking on additional risks that you would otherwise do.
Absolutely. And you mentioned there you're 32, 33.
Correct.
And essentially financially free. So you don't, even though you work a 9-to-5 job, you don't really need to. Is that right?
Yeah, that's correct. Without disclosing all of the numbers at this point in time, the net cash flow position I like to take net cash flow in after paying principal off. Even though that's a transfer of wealth to myself, effectively, it's the end goal is to own the real estate, and so the net position after paying principal off is around $50,000 a year. Now that doesn't seem like a lot of money, but the reality is if you have a good, strong budget and you live within your means, then that's enough to sustain a fairly comfortable lifestyle.
Absolutely. And you're paying down debt as well.
Correct.
Which is an incredible position. So if you switched it to interest only, you'd be in an even better position. And the fact that you're paying down debt would mean your holding cost would be less. So your cash flow figure would be high.
Significantly, yes. Yeah, it's one of those, how do I manage the risks the way that I want to manage risks? I don't like the idea of being 70 years old and having an 80% LVR portfolio. And so if you're going to get into debt, I highly encourage people to have a plan to get out of debt. And in this case, it's paying principal off over the long term.
Yeah. We'll probably come back and touch on that soon as well, as
sure.
LVRs for portfolios, paying down debt, and at what point in your investment journey should we switch from accumulation phase to paying down debt phase. Everybody's journey is obviously different. Yours at the age of 32, 33 is probably a lot different to other 32 and 33-year-olds.
Yeah, definitely. Yeah. It's actually quite a big learning process once you get into a position of, let's say, financial independence. I did manage to take some time off work. And that was actually some of the loneliest time that I ever had, because there wasn't anybody to spend time with. And so I found that work is good for the soul. You get to interact with a lot of people. You continue to learn and grow and develop yourself. And so that's part of the reason that I've ended up coming back to work. But it's more work on my terms rather than working because you have to support a lifestyle that you want. So, yeah.
What made you get into investing in the first place?
That's an excellent question. I have been fortunate enough to be brought up in a household that has a strong sense of let's say financial communication. In my opinion, the areas in which the human race develops the most is the areas that are talked about openly and honestly. Things like technology and scientific developments have gone further in the last 10, 20 years than they have for a long period of time, because we are in an information society at the moment, with access to information, with the internet and reading materials and whatnot. And I was very fortunate to be in a household where I had investor-based parents, and they would talk numbers and finance at the table. So I wasn't reliant on the education system that other children have, and it wasn't taboo to talk about money. And
It
so
is for a lot of people, isn't it? Like talking about money around the dinner table as well is just a no-go in a lot of houses.
Oh, definitely. And even if most people would relate to this. Just even asking a very close friend how much they earn at the job that they're working, it can be very uncomfortable for a lot of people. For me, it's not, but it's quite uncomfortable for the other person to answer that question. But that's because of the society that we're brought up in. It's that dinner table conversations that people aren't used to. We should celebrate people's successes, which is why I love to learn as much as I can in this particular space. And quite often I'm asking myself, how do I get to where you are? If you've got something that I want, how do I get to where you are? Can you teach me what it is that I'm missing to get to that,
questions.
Point? So
great questions. The other thing about money as well, a lot of people think people with money are greedy, or they've done something bad to get that money as well. So again, a lot of people are conditioned to think that money is evil. How did that come across to you with having these conversations across the table at such a young age? Did you ever think money was a good tool or a bad tool?
It was really just taught to us as a tool, right, itself. It wasn't good or bad. And what I've learned over time is money just makes you more of what you already are. If you're a generous person without money, you're an extremely generous person with money. If you're, excuse the French, a bit of an asshole without money, then you're a very big asshole with money. You can be quite a pain in the butt. And so really what money does is it gives you that freedom to express who you are fundamentally. As a person. So if you have good, solid foundations where you celebrate the successes of other people and you practice gratitude and you're generous, providing yourself with opportunities, then you'll find that money flows to you more frequently than it does others.
And a lot of people as well, and this is generally, from what I found, this is generally a phrase from people without money, is money does not make you happy. Would you believe that's true or false?
That's an excellent question. What's that famous saying? Is money doesn't buy you happiness, but business class is nice, or something along those kind of lines. Like I'm not going out there purchasing business class because that's how you live on a $50,000 salary. But I don't think it actually makes you happy. Having money is really, it's an extension of responsibility. The more money, the more investments, the more that you have to manage, it's the more responsibility that you personally have to take on. People think what people actually want, and I was studying this recently, is they don't want financial independence because it comes with responsibility. What they want to be able to do is actually purchase things without having to worry about the cost. And that's different to actually, taking on the responsibility of managing a portfolio and effectively creating a side hustle or business that provides a form of cash flow to supplement your lifestyle, because there is a responsibility in that. So it's certainly not evil, but it comes with responsibility. And if you take on that responsibility, you should really step up to the plate.
And if you learn how to invest money and make money work for you, then there comes a point where you do not have to keep working for money.
Yeah, 100%.
Where we're at now, yeah.
Well, definitely. I've done a lot of thinking on this, right? And at a very young age, and this should be thrown around, and people go, "Oh, time is money." And though that in its simplest form is true, really it's money is a function of time and effort. That's the key part, is that if you go to work and do a day job 9 to 5, you're actually exerting effort plus time in order to trade that for money. People forget about the effort part. And so when you invest and are able to build up let's say a passive cash flow position that pays you, there's still effort involved in managing it, but it's significantly less than if you were doing a 9 to 5 job. And that's something to note as well.
Yeah, absolutely. There's nothing in life is truly passive.
100%. Yeah.
Like,
yeah.
managing money requires time and effort, but working 8 hours a day for somebody else also requires time and effort. And that amount that you can get paid in that position is generally capped unless you are a exec of a business director or whatever. The higher up the chain you get, the more you get rewarded because there's less people required at that stage. But it's definitely, where was I going with that? Yeah, there's a limit to what you can earn if you're not investing money, and we need to make the money work for us by putting it into certain things. But at such a young age as well, people say you need money to make money. How did you get to the position that you're in now at such a young age?
I want to give people some hope here, right? Because I haven't got any inheritance. I want to make that very clear. This is all hard-earned position, and I haven't been a high income earner. When I started working, I started on a salary of $50,000 a year. So after tax, I remember at the time, because I was doing it was $43,000, and I decided, and this when you set a budget for yourself, I decided that I wanted to save $24,000. So I lived on 19 grand a year. Now that is not a lot of money. That is significantly less than what the government gives and the poverty line and all this kind of stuff. What it forces you to do is think differently, right? So it can be done. I was doing things like renting, 5 or 6 bedroom houses in the areas that I was living in, and then subletting out the individual rooms to pay for my portion of the rent. So my rent would be zero, and that would be saving money. And so this is like the process of thinking differently. Shopping in places where you get bargains, finding these apps or newspaper clippings that give you 50% off for certain items of food, bulk buying, thinking differently than what other people do to get yourself ahead in the early stages makes a big difference over the long term. There is a negative effect to doing this. Once you do this for a long period of time, you get used to it. It becomes habit. And so while, I don't drive around in a fancy car, I have $8,000 Suzuki Swift that I drive around in because it's habit. I can afford something more expensive than that. I choose not to. I'm still renting because it's cheaper than owning a home. It's things like this, making conscious monetary decisions that help you propagate your savings that you can then use to invest and create more wealth for yourself. Every little dollar counts, and the earlier you start, the harder you go, the easier it gets over the long term. And you can start to relax it as you become more stable. It's quite an interesting journey.
As you're telling that story there, I'm thinking of the phrase, you've got to live a few years like most people won't to live the rest of your life like a lot of people can't.
That's an excellent. I've never heard that. I've been doing a lot of study from Dave Ramsey, who is an American wealth creation expert, and he has a very unique perspective. He doesn't do debt, but one of the things he says is live like no one else, that you can live and give like nobody else later on. And that's quite a powerful statement too.
Yeah. But when I first got into investing, I worked in the oil and gas industry, and myself and Joe, our wages combined was just over $300,000 a year between us.
Yeah.
But we used to spend all of that money. So we thought we had a really good lifestyle because we had a nice car and clothes and 3 or 4 holidays a year, but we had no asset base to show for it. And we went from living that type of lifestyle to being incredibly frugal. We had money management spreadsheets, so we knew where everything was going.
Yep.
X amount of money going into bucketing systems so that we could cut back and put money into certain buckets so that we knew what we could spend on certain things, which was Barefoot Investor, which kind of ties into the Ugg boot investor.
Ah, yes, Scott Pape.
Yeah.
His book is brilliant.
Yeah.
I will endorse that. But I'll ask you a question on the comments that you've just said. How easy or hard was it to go into be more frugal than it
Very
was to
hard.
let it? It was very hard.
It was hard.
Yeah,
We went from having holidays with friends and weekends away with friends to all of a sudden having to say no to a lot of people.
Yes.
And yeah, cut back on a lot of the things that we were really enjoying in life, but not necessity.
Yep.
Just overindulgence in a way. So we really cut back, and we live by that phrase. You've got to live a few years like most people won't to live the rest of your life like most people can't. And
look, it's something that I wanted to bring forward. Exactly what you said. It's easier to let the purse strings loosen than it is to tighten the purse strings on your own savings. So you've just indicated how difficult it was. There's a big psychological impact on, I'm going to be letting my friends down or my family down because I can't go to this event.
Yeah.
And it's simply not the case. People respect the true friends and family that they have, respect the decisions that you're making. And if you just explain it to them, this is not for you, obviously, but it's for the people listening to this. If you explain what you're trying to achieve, you really want to surround yourself with people who support the objective over the long term. It is more difficult to go backwards. Once you're used to a certain type of lifestyle, it's very hard to undo that lifestyle. So, I mean, congratulations for doing it. I'm somewhat lucky to have started at the bottom and worked my way up rather than start at the top, go backwards.
I remember specifically, we had a event down in Margaret River. It was a full weekend wine tasting event, and we didn't go to it because I went to a networking event instead.
Yep.
And these networking events have changed our lives. We've met other investors, joint venture partners, and it's really helped us accelerate our journey to get to where we are now. So it unfortunately, it might be painful at the time. There's a lot of people that we speak to that are doing fly in, fly out and earning really good money and living like kings for the 3 weeks that they've got back in Perth, but then they're going back to work with virtually nothing. It's like spending everything, which, you know, I can relate to it because I've been there and I've done that and I know what they're going through. But
I can literally relate to that. It was not even a month ago. My wife is a doctor and she had some formal education that she needed to do interstate. We looked up the return plane tickets. It was $1,000 return. So effectively, we made the decision to drive down because it's a tank of fuel. So instead of paying $1,000 return, we paid, $150 in fuel. There was the effort in doing that, and we got to an Airbnb that charged us over the 4 or 5 nights. I think it was roughly around $550 or so. And when she's talking to all of her, fellow doctor colleagues that are doing the events, they're staying in hotels paying anywhere from $3,500 to $5,500 plus the flights on top of that. They just don't have, specifically if you're a high income earner, the mentality is that money is easy to come by. So then you can spend it. But all of that would otherwise could be used as savings to invest in something else. You're making a personal sacrifice in order to make those decisions. And it's difficult for a lot of people to do that.
Yeah. Well, let's talk about investments then, because there's a specific type of investment that you like to invest in. Now, when we think about all the different investment models out there, there's obviously business, there's property, there's shares, there's commodities, there's crypto. Out of them 5, that was 5. What's your kind of go-to investment model?
For me, I structure it 2 ways. I don't think cryptocurrency is an investment. I think it's a gamble. If you can't guarantee that you're going to get your principal back, then it's not really an investment form, in my opinion. I just wanted to kind of put that out there. We have what we call a passive portfolio and an active portfolio. So a passive portfolio is, I can't quite remember the term for it. I think it's called dollar cost averaging. But effectively, we put in a standard set amount each week. We don't care what the price of the asset is. We just purchase it, and we're going to be purchasing it for the next 40 years. We're not going to look at it. And that is index funds in a stock portfolio. An average growth rate of 7 to 8%. If you're putting in $10,000 a year, so roughly $800 a month, and you just put in $800 monthly over the course of 35 years, you'll have about $2.2 million. So that's a lot of money for really not a lot of effort. There's no management in it at all. It's just, I'm just going to put it in, I'm going to forget about it. And then when I retire, I'm going to look and have a smile on my face, really. So that's the passive portfolio. That's really what we're calling the fallback plan. Yeah. Then there's an active portfolio, and the active portfolio for us is property. And the reason that we pick property is because even though a lot of markets are effective in the aspect of the prices at which you pay for something is going to be generally, let's say, market value. There's not going to be necessarily an opportunity to buy something and then sell it on to somebody else at a higher price. With property, you have a little bit more control, where you can add something called perceived value to the property. But also, property is an excellent vehicle for cash flow, where stock market is not an excellent vehicle for cash flow. It's an excellent vehicle for capital growth. So we do what's called positive gearing or positive cash flow investing with property, which is our strategy. It's not the riskiest strategy out there. It's actually quite tame. It's one of those ones where if you keep going at it, you end up seeing effectively what I've termed as like the spiral of success, which is if you purchase something that gives you cash flow, it adds to your savings, which allows you to purchase more because you have more savings. And so it just kind of keeps going, where, it doesn't take long for you to be all of a sudden every year you're purchasing something, which is quite an exciting journey when you get to that stage.
The power of compound interest, I suppose, isn't it?
100%. 100%. But it's also the cash flow that allows you to retire. Yes. Capital growth does not allow you to retire. You can't live off capital growth or debt. So
you can't eat capital growth.
100%. You cannot eat capital growth. That's a good one. Yeah.
So why did you choose to go positive gearing over the traditional negative gearing? That's been quite big in Australia over the years, hasn't it?
Look, the way that I would define it is simply this, is that if you want what everybody else has, do what everybody else is doing, and when you look at what, 95% of, let's say, the investors in the marketplace, they're all going, how can I save tax? The reality is that in order to save tax, you must lose money in order to reduce your taxable income. I'm not interested in losing money. I'm in the business of making money. And so I would rather pay tax and make money than lose money to save tax. It's really that simple. And so when you sit there and think about it and you go, if property is such an excellent vehicle to make money on it, why do so few people succeed in actually doing it? When everybody talks about, if you just bought property, 10 years ago, it would be worth more, you'd be in such a good position. Why isn't everybody doing it? It's because they're limiting themselves with negative gearing. It's really that simple. I hate negative gearing.
My accountant, Nitin Vashish, says your investment strategy don't let your tax strategy run your investment strategy. Your investment strategy should always be guided by one thing, and that's return on investment.
Oh, you got a great accountant, because most accountants don't know left from right, really, when it comes to this space. And it's unfortunate because they're trained to save tax. That's what they're trained to do. And so when people talk to them and they say, I want to reduce my taxable income, they say a method of doing that is purchasing a negative gear property. And it is a method of doing it. The consequence of it is you're losing money over the long term.
And it only works, negative gearing only works for two things. It only works if you get capital growth. And it also only works if you are in a job, so that you can offset the loss against your income to save tax. Now, if you want to get in a position like you're in and replace your income with cash flow from real estate, you're going to have a really tough time trying to do that with a negative gear portfolio, aren't you?
Yeah, well, 100%. When I started 10 years ago, I said my goal is to incrementally increase my income through investing so that I can replace a day of work and then 2 days of work and then 3 days and eventually get to zero. You've nailed it on the head. When you take on negative gearing, you are forced to work to pay the difference in the mortgage costs that the property it requires of you in order to keep that with the loans. But in order to actually perform with a positive amount over the long term, your capital growth has to not only outperform the losses that you make in cash flow, it also has to outperform the incremental effect of inflation over the time that you own the property as well. So you're getting hit with double whammies here.
Been big lately.
Yeah.
Let's talk about do you know when you mentioned earlier how you left work and you were feeling quite lonely? Do you think that's a fear of some people? Like, because business and work ties into a lot of the basic human needs. When you stepped away from your job, how long did it take you before you realized there was something missing, and then what made you want to go back?
At first, it was euphoric. It's like, I'm finally here. I've done what I wanted to do, and I really enjoyed it. Like, I really did. And then what happens is you take a couple of knockbacks. It's like, hey, I'm free. Do you want to catch up? Sorry, I can't. I've got the family, I've got the work commitments, I've got this, I've got the mortgage, I've got. All of a sudden, you go, knock one, knock two. I can't speak with this, I can't hang out, I can't do that. You start to live a very solitude-based life. It must have taken me about 3 to 4 months to realize it, and at which point that's when the UGG boot investor was created, because I thought, well, if I'm going to be at home anyway, unable to hang out with my friends and family like I want to, let's find a way to contribute back in some way. Let me try and help someone else with some knowledge that may change their life for the better in the future. That's my ultimate goal, really.
Yeah. And you've been getting some good traction on the YouTube channel too.
Yeah, look, I'm not a big YouTube star. I'm not claiming to be, but it's not done for monetary making purposes. It really is done to try and help people understand different circumstances and make better financial decisions. Yeah. That's really all I'm about. So
there's lots of good, useful information and knowledge packed videos on that YouTube channel. So check it out, the UGG Boot Investor. Yeah, I learn things when I go on there, and all the videos that the UGG Boot Investor brings out, I've been watching them as well because they've been popping up in my Facebook feed. So
thank you.
Yeah, it's good, but like so much of it resonates with everything that I've learned from the mentors and coaches I've had, like buying in trusts and like buying positive instead of negative. Like, where did you have any coaches and mentors when you were younger about investing in cash flow positive properties?
Yes and no. So my parents were neutrally geared real estate investors, and that was a big difference. That was an impact. And at some point, I looked at it and said, that's just not quite right for me. There's something missing, because I want to get into a position where I'm not forced to work. Neutrally gearing still doesn't do that for me. And they're trying to justify it by, well, negative gearing has more capital growth. Says who? There's no justification or proof out there that negative gearing outperforms any positive gearing real estate on a capital growth perspective. One of the sayings that I have created is invest in the known, not the unknown. I know cash flows. I know the rents. I know the mortgage repayments. I know the interest rates. So I know what the cash flow position is of each investment is that I'm choosing to engage in. What I don't know is what it's going to be worth tomorrow to somebody else. Yes. I don't know if it's going to be worth more. I don't know if it's going to be worth less. I don't know if it's going to be worth the same in 10 years' time. But if it's producing positive cash flow, it doesn't matter if it's worth more or less, tomorrow. It really doesn't. Yes. So you can just hold it for a long period of time and still get the benefit from it. So that was what resonated with me. And that all started from a book by Steve McKnight, which was 0 to 130 properties in 3.5 years. Oh, it was a brilliant book. Yeah, and I'd like to think that he and I are fairly close. I know he's closer with other people, but I have studied underneath him for more than 15 years. Like when I was when I was 16 years old, I think it was Kevin Rudd gave the $300 stimulus out. I used that $300 stimulus to go to a 3-day weekend conference with Steve, which cost $299. So that's what I did with my stimulus back. So I was the youngest person in the room. I'm just trying to absorb as much as I possibly can, and he's preaching that positive cash flow. So I get the opportunity to speak to him from time to time, but he is an outstanding person with a high level of integrity and character, and I could not recommend his material enough to anybody. So
great investor as well. He's doing some amazing things. I know quite a few of our clients are in a fund that he's got in America, which is getting incredible returns. Are you in that one as well?
I was not at the time that he brought it out, which was 10 years ago. And by the way, for his character, he has managed this $100 million US fund with Australian investors and achieved an average return of 16% year on year. So that is a phenomenal result, right? At the time, that was 10 years ago, and I was quite young. It was pretty much all of my savings. And I was looking at purchasing my first investment property for about $100,000. So I didn't need a large amount of money down. And so I shook Steve's hand and said, thank you for the opportunity, but I'm going to learn more by throwing the money into the market and giving this a go myself than by just handing it over to a seasoned investor. Not that the returns would have been poor, but I appreciate the journey that I've gone on instead. So
there's a lot more to be learned than doing than actually getting someone else to do it at the same time, isn't there?
Oh, yes. Yeah. I can tell you this, and I'm sure this is the same for you and everybody else who's done it. It is very scary jumping outside your comfort zone. The first time you purchase a property, whether it's your family home or an investment, whatever that may be, that is a very scary jump to make because it seems like a lot of money. The reality is it's not, because if you had to sell, you'd probably get your deposit back. All right. But people don't look at it as a deposit value. They look at it as it's the total sum of the investment, $500, $600 odd $1,000 or even more, depending on what position or market that you're investing in. But once you've done it, it becomes less scary. It's easier and easier each time. So.
And it's good. Like I know I said, it's good to do it yourself, but there's lots of ways that you can be involved in a process as well. Like when we work with our clients, and you are very fortunate. We are very fortunate that you're one of our clients. We try to include our investors and our clients in the journey as much as we can on the way around. Would you say that's right? Accurate?
Yeah, definitely. It's something I've actually appreciated a lot. I mean, you guys are based in Perth and I'm based in New South Wales. So we are 3 hours by plane away from each other, right? I'm not going to be able to just drive down and check out what's going on in the property. And so, I have to have a degree of trust with you guys to be able to execute on a quality product. But the information that comes through on that journey is next level. You take the customers, in this case, me, I'm a client of you guys, on this journey where it's like, this is where we're up to. Here's the photos. If you have any issues, give us a call. We walk it through. We have the discussions. We work it all out. It's fantastic. Highly, highly recommend. So,
and a lot of people think that the journey of buying real estate and doing the amount of work to it is relatively straightforward, but it hasn't always been plain sailing. We come up against issues, and we pick up the phone, we have the conversation, and we say, Richard, this has happened. Like, this is the outcome that we're going to have to take, or the direction that we're going to have to take.
Yeah, it's kind of, it's like if a boss or a manager comes up to you and says, hey, I need you to get this job done. You come across a problem. You don't come back to the boss and say, I've got this problem. You come back and you say, we've got this problem. Here's our proposal as we're going to get through it. And I feel that that's a much more comfortable approach in the process. But definitely, investing is not smooth sailing. If anyone tells you that, then they really don't quite understand or haven't had the experience to justify. Things go wrong all the time. It's the assumptions that underpin the investment that really drive the the success of it. And so always plan for something to catch you off guard. Always have like a sunk fund effectively, or a sinking fund, just to kind of deal with any kind of problems that turn up. Because when they turn up and if you can't deal with it, that's when it gets expensive. If you can get through it, get to the other side, that's when you'll reap the rewards. So, yeah.
And in regards to when we first saw, what have you got now? 3 properties?
With you, yes.
Yeah. With the properties we found for you, and when we sat down and said, Richard, if we purchase this for this much, renovation should cost this much, and the room should rent out for this much. How accurate have we been with them figures across all 3 properties?
It depends on the what you're referring to. The figures are fairly accurate for the costs involved with the renovations and the in and outgoing costs. But I've actually found that you guys have underquoted the rents. A portion of that could be the market has moved on the journey of finishing a project, but I actually think that you're trying to cover your ass a little bit. I'm just calling it there. You don't want to be in a position where you go, it's going to achieve $300 a week and it only achieves 250. That doesn't look good. But the reality is you're saying it achieves 200 and it actually achieves 250, which makes it difficult a little bit to kind of go, well, what's the actual value of this particular property? So it's understated in a very good way, because when you decide to pick on something and then you get a better result, that's awesome. So
yeah, well, we like to under promise and over deliver.
That's literally it. That's literally it. So.
Let's quickly touch on trust structures and why, because all your properties are held in trusts, if I'm correct in saying that. And
incorrect, actually.
Incorrect.
Yeah, they're held in companies, but trusts are a very, very viable option. I understand them very, very well. What would you like to talk about in this space?
You've got some content on your YouTube channel around trust structures and why you invest in them, or why we should invest in them, and why they are effective when it comes to tax minimization, asset protection as well.
Yes. Yeah, that was a good one.
State before this, this is not advice, and
their
own specific advice.
Yeah, this is definitely not financial advice. You need to speak to your professional financial accountants and legal teams, respectfully. But the reason that I invest with structures rather than individual names is it allows for continued serviceability. You as an individual have a set limit of your own serviceability that you can actually manage. So in my case, for example, let's say that I could actually purchase $1 million worth of real estate. Well, that could be spread between each structure. So if I purchased in a trust, that trust has $1 million because it's banking on my serviceability. And then I can set up a second trust and borrow another $1 million based on my serviceability. Now, this only works if the trust or company is making money. It does not work if it's negative gearing. Because as soon as it's negative gearing, it must be declared to the financial institutions, and that declaration has an impact on your ability to move forward. So the reason you use trusts and companies is that you can distribute income to your family in a tax effective manner, and it also allows you to continue to progress. There is a good video you can check out on my channel which describes it a bit better in detail.
They are such a really good way of holding real estate and other investments as well. Our businesses are set up with trusts as well, just trading trusts, just such a really flexible vehicle to use and pass money through as well. Really.
Oh, definitely. Yeah, I definitely agree. Look, the advantage that trusts have over companies in purchasing real estate is that when an institution looks at it, the trust acts on behalf of the individual. So that would be you, the investor, and therefore you have access to residential loan structures. So you can easy access to 80, 90% LVRs if that's what you're looking for. If you were to go with a company, you don't get access to residential loan structures as easily, and therefore you go through commercial lending, which kind of restricts you to 70 or 80% LVRs. You have to front up more cash. Now, the reason that we go with companies is that it can retain the cash flow inside the company, where a trust must distribute its earnings to its beneficiary. You can throw that into a bucket company if you want to. You need to talk to an accountant about how to set that up and how that actually works, and if that's beneficial for you. But if you don't have a bucket company, it must go to you. And if you're a high income earning individual, then you'll be paying more tax rather than just keeping it in a company structure.
Yes, absolutely. Absolutely. Mate, we are getting close to the end of the podcast. So what are you looking to invest in over the next like 2 to 5 years? Have you got your eye on anything in particular, or?
Yeah, this is actually a good question, because there's a lot of fear out there at the moment. And I'm just going to say it. It's always a good time to invest if the numbers make sense. And I think right now, not financial advice, I think that right now there is a discrepancy between the increase in market rents that have gone on based on a lack of supply and the current price. I think it's an excellent time to be purchasing investment properties, like an absolute excellent time. I am looking to purchase 5 by 2028. Which will be a fair few $1 million worth of real estate. That's the plan at this point in time. If the numbers stack up and you're making money, there's no reason why you shouldn't be going into the deal. Really, it's that simple. And if you're doing positive cash flow, as we've already discussed, it doesn't matter if it's worth less tomorrow, because you're making cash flow to support the cost of the mortgage anyway.
Yeah. I mean, we've got to look at even just basic supply and demand principles right now, especially in particular in Perth. I know Sydney's CoreLogic released their data for the first quarter of the year, and Sydney last month had a 0.4% price increase, which is, I haven't got the full breakdown on them statistics, but that surely must be the top end of town buying again, because that median house price is just too far out of reach for people that are on a medium wage.
Yeah, at the moment, it's quite expensive for a lot of people to get in. And specifically with this generation, you're seeing a lot of people in my generation where they're still even living at home because it's too expensive for them to move out. And, I sympathize and empathize with that plight. But I'm not exactly sure what that impact is, but I still think property prices are low at that middle to lower kind of entry level bracket.
In Sydney, in New South Wales, or in Perth?
In Perth specifically, which is where the focus for my investing is right now. That's not where my entire portfolio is, but that's where the focus of it will be.
Yeah. I mean, we've got to look at, like I say, there's supply and demand fundamentals. Right now, we've got the lowest amount of properties we've ever had on the market since I started recording this. I think it was 50 years ago, 1970 something, might have been a little bit early. We've got under 2,000 properties. I think there's 1,700 properties available for rent, and 1,000 of them are roughly houses, and the rest of them are units or apartments.
Yep.
And then when we look at houses to purchase on the market right now, I think there was like 7,800, and 3,300 of them are houses. A small portion of them are units and villas, and then the rest of them are blocks of land. I think it was like 800 blocks of land or something. But then we look at how many people live in Perth. So right now we've got 2.2 million people, forecasted to be 2.5 million by 2030, which is only 7 years away. So it's a big increase.
Not that far.
Right now we've got a skill shortage in Western Australia, and we apparently need to bring in between 55 and 65,000 skilled migrants to fill all the job vacancies, because we've got the lowest unemployment and the highest job vacancy rate we've ever had. And then apparently there's over 150,000 students that are being forced back out of China into Australia in general. It's because they've been told that they need to go back to their country that they were learning to get their degree in for it to be recognized in China. So we've just got this crazy influx of students and skilled migrants coming back into the country now. And I'm not a little bit biased, but Australia is the best country on the planet, and I do believe Western Australia is up there with one of the best. They're one of the best states to live in. It's just such a beautiful place. So we've got, I really believe capital growth around the country is going to be pretty strong because of the demand for people to live in this country. But Western Australia, with the lowest prices in the country, apart from Northern Territory, I believe, and that migration increase that's coming in, we're apparently 40 to 50,000 houses short now, and that's before all of the other migrants come in to the country.
Yeah, and it's a big reason why, people were if you take a look at some of the articles, they're like, oh, the house prices are going to drop 20%. It's, it's going to be pre-COVID kind of numbers. And a big reason why it hasn't had such a large impact is because literally the supply demand, there is far less supply on the market. And so even if there's a drop in demand, because there's such a drop in supply, the prices aren't shifting that much. It's simply what you've described as a supply demand curve in its simplest form.
And what's your viewpoint on the RBA rate? It got increased today. The date is the 2nd of May. So the RBA released their latest lost it. They've released the latest interest rate on the cash rate. So it's gone from 3.5 to 3.7, if I'm right.
I'd have to check it. I don't actually keep a close eye on the news, but what I can tell you is that the average interest rate for Australia over the last 40 years has been 7%. And even if it's 3.5 or 3.7, whatever the number is right now, it is still cheap in comparison to what the long-term average has been. The problem that people are seeing is that, a small percentage growth on like 1%, 1 to 1.5 is a 50% increase in interest costs. Where if it goes from 7 to 7.5, that's significantly less of an impact on somebody's lifestyle. So for those people who have maxed out their borrowing capacity, they're going to feel a massive squeeze, which is where all of the drama is coming from. So ultimately, when you step back and take a look at it, it's still a cheap interest rate over the long term. My parents' generation, your parents' generation, they have lived through 18, 20% interest. I hope we don't get to that point, right? Yeah. But if I was to take a guess, and it's only a guess as to what's happening, is that the RBA has a pendulum, and they only have one thing that they can do to affect the market, which is adjust the cap rate with interest rate, right? Cash rate, right? So they only have, that's the only tool that they can do, and I think they've swung the pendulum too far, and eventually it's going to pull back a little bit. They're going to have to, just to kind of like normalize things off with their strategy to reduce inflation back down to, is it 3% over 3 years or something like that? That's the goal. So that's the only tool they've got. They've got to swing it really hard one way in order to pull it all back so it doesn't get out of control. And then they're going to have to ease off the pedal a bit as the pendulum starts to swing back the other way.
Yeah. And one of the greatest investors on the planet, Mr. Warren Buffett, says, be greedy when people are fearful and fearful when people are greedy.
Very true. Very, very true.
Last question. If you had $1 million to invest right now, what would you be investing in and why?
If I had $1 million right now, I don't have a family home. So I'd probably buy a family home outright, which would reduce my ongoing expenses, increase my savings, and then allow me to continue investing in multifamily positive cash flow dwellings, which is what you guys are doing. If I had my family home right now, I would split that up 4 parts using maybe like 25% of each one, so 250 grand on each property, keeping the LVR rates a little bit lower, because just to reduce the risk exposure. Like if you had $1 million, why would you want to throw it away? Why would you want to take on the extra risk? So
exactly. I know that I said that was the last question, but very important point that you picked there. So you've chosen to rent for the time whilst you've been investing. And sometimes I get people contacting me saying, I really want to buy my own principal place of residence, but I'm tired because I also want to keep investing. When do you think is the right time to stop investing in investment properties and put some money into your own principal place of residence?
This is a question that will be very controversial. So if you look at people like Scott Pape, he actively encourages people to purchase a family home first. And that's because it can take a long time to save money for a deposit, which is a justification. The tax systems in Australia are set up so that you buy your family home. You're locked into a contract for 30 years. And by the time you retire, hopefully it's gone up. You downsize, you don't pay any capital gains tax on that. And then you can live off the difference that you would have made over that 30-year period. I am a personal believer in a position where you make the personal sacrifices, you build up your investment portfolio such that the income itself pays for the cash flow position of your principal place of residence. So if in my position, the income that I receive is $50,000 a year from my portfolio, I would be comfortable in having a $50,000 per year cost of a family home, which is the equivalent of about $800,000 at an 80% LVR. For those that are actually interested in the numbers. So,
and when you said there, this answer might be controversial, I actually didn't think that was controversial at all. That's exactly what I would be saying myself.
Well, Steve McKnight, who is another big proponent, has written a new book that's come out called The Money Magnet, and it's an excellent book. And he addresses a chapter in there called The Great Australian Nightmare. It's an excellent chapter. Everybody should read this book. Everybody should read this chapter. His justification, and I'm not 100% sure that I agree with it, is that you should not purchase your family home until you have enough money to do it outright. So he's saying that invest hard, make enough money, buy your home with cash. Where I'm saying invest hard, make enough money, buy your home with investment cash flow. Yes. It's a slightly different perspective. So
absolutely. Mr. Ugboot Investor, thank you very much for your time. It's been a pleasure catching up.
Thank you, Neil. It's been great. Hopefully we can do this again.
You're very welcome. Chat soon.
See you, mate.